Welcome to the CU 2.0 podcast.
Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by Quillo, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
Suddenly, youth banking is back in the conversation, and that's because this time there's real optimism that it's a product that's emerging at the right time. Case in point of the optimism is a recent Finovate article headline, Why Youth Banking is Set to Surge in 2025. There's a link to that article in the show notes. Better news is that this market isn't solely for the big banks and fintechs. Now on the scene is Incent with a youth banking tool set, and it's launched a CUSO that right now has one member owner, Idaho-based Pioneer Federal Credit Union. That's a $700 million institution. Many credit unions already are signed up to be customers of Incent. On the show to tell about why now is the time for youth banking and the product is Incent are Marcel King, president of Incent, and Tracy Miller, EVP of Pioneer. It's a good show. Just may convince you that youth banking is for real this time. Listen up.
I think the impact of not addressing how to acquire youth has just become exponentially more important because the folks continue to age, right? So I think that's number one. And number two is you pull in the great wealth transfer, and you got, depending on who you're reading or what you're reading, could be anywhere from 60 million to 90 million on the great wealth transfer. If you as a credit union do not have the accounts of either the kids of the retiree or the person that's passed on or the grandkids, that money is going elsewhere. So you start thinking about that from an age perspective. Basically, we got 53, average lifespan is 72. You got 20 years. Yeah, it's a ways out, but still, you need to be thinking about that now because there are companies like Greenlight, Busy Kids, Go Henry, Step, you name it, that are all focused on that, call it youth. And then you've got the young adult companies like Chime, Revolut, SoFi, et cetera, that are focused on those customers. And across the two of them, there are almost 100 million subscribers. That's a third of the US, right? So credit unions have to take action in order to acquire and retain those youth, because if they don't do it now, it's going to cost them probably a lot more to acquire them in the future if they even have an opportunity to do so.
You know that one of the interesting phenomena, for years I heard credit union and bankers saying, now people will only bank with a government insured institution. Now someone should tell those people at Chime that it's not government insured, because they seem perfectly happy. It's a whole generation that doesn't give a damn about that government insurance stuff.
Exactly.
Yeah. Tracy, so why are you hot for this?
I think just in my career in the credit union space, I don't think credit unions really had the technology to begin with to really take and really look at what they could put in the youth space. We had savings accounts, and that was where the youth were placed, and we gave them great CD rates because that's what credit unions do. But we really never understood how to transition them until credit unions started to get more savvy in the digital space. Credit unions are players in the digital space now, where a large number of us, especially at Pioneer side, we were just starting to enter those spaces just for your basic saving and checking account. And then the next minute, we're into moving money. So I think some of it comes around those pieces for me, is where we're a lot more technology savvy. I think we understand a lot more of it. And not only that, even our youth and our grandkids are starting to get more savvy in those digital spaces. So if you're not looking at youth products and really building them out to move and to give the parents the tools to teach them how to educate in finances in that digital space, I think you're going to get left behind.
Marcel, why did you form a QZO?
A couple of reasons. So this is the third QSO that I've been a part of and building it out from the beginning with Payveris. And we created a QSO and we realized the benefits of that. Number one is it allows us to partner with the institutions and the folks that are managing and running these institutions to collaborate with them to build the technology. Most credit unions do not have their own development teams, right? And then when I say development, yes, there are development teams for building connections or widgets or things on those lines, but building kind of a platform from the ground up, there are very few that do that, right? So the ability to partner with from the technology side on our end and with the insights and information and the actual members that they have that they interact with, it's a collaborative process. So we're able to build out together a best-in-class product, right? Because of the way that we structure the kind of product and innovation council, right? That's where we get all of our insight in terms of what needs to be built for the most part, and also kind of what are the priorities. Now, of course, we come to the table with, hey, here's what we think you should have. What do you think about it, right? So it becomes a collaborative process. So I think just the ability to partner with the credit unions directly and to have them have some skin in the game as well. It really pushes us and it pushes them to build out the best products in the market. And that's what we found previously, and that's what we continue to see. In fact, there's a whole industry of QSO investments, whether it's a Circle or TrueSage or whomever it might be, that's doing the same thing, right? And I think both sides see the value of that investment into their technology provider and the collaboration and partnership to build out a best-in-class solution.
Well, Navy Federal just became a Circle investor.
Yeah.
And if Navy sees this as something they need to be doing, everybody sees this as something they should see this as something they need to be doing. There's no credit union in America that has significant computer development skills internally.
Yeah. Even look at like a Navy, right? Your largest credit union in the country, and they're still looking to partner. It's almost impossible for a credit union to run, manage, build, and continue to keep up from an industry perspective when they build things in-house, because there are other priorities that generally come up, and then they generally go into maintenance mode on one product while they start looking at building another one, and now that one product becomes kind of a nascent laggard in the industry from a kind of functionality and innovation, right? Where you've got purebred companies that are focused on continuing to build and innovate in whatever segments they are, to your point.
So both of you answer this. What's different now where there's confidence that you can create tools that kids actually want to use? I think the problem with a lot of the predecessor use banking tools was that adults thought they were cool, but kids didn't. So what's different now?
I have a 9-year-old son, and he wouldn't have a clue what a checkbook is. So for me as a parent, and I have a young son, 9, and my oldest, she's in her 20s. So I have them in 2 different age gaps. My 20-year-old, I taught her how to balance her checkbooks as she grew up in her accounts on a piece of paper inside of a ledger. My son, the world has changed, and there's no way to train him how to do anything on a ledger, or to how to teach him the difference between savings, wants, needs, and then eventually into how lending works. So for me, I think it works because they're very familiar with it. They don't go to paper anymore. They're going to the digital spaces to do it. And I think not having those digital platforms where not only does it put more controls into the parents' hands, but also way they're educating their children in those financial spaces, they're doing it with a partner they trust. We have parents that come in here, and when we tell them that we don't have certain tools in those spaces, they look to us to now have them. Where before, I don't believe that the parents or the grandparents that were bringing and starting their youth, the children accounts here, were looking to us for those pieces before. But now that the digital space is here and it's moving so quickly with so many different fraud aspects and other avenues, they're looking to us to educate on both sides. And I think that's why it's more important in this time to really start focusing in those spaces and make sure that those foundations are good so that we can continue to grow, but also meet the needs of what we're being asked to do. I think it is our responsibility to help parents, especially in the financial space, so that they can educate their children and give their children the tools that they need to be able to maneuver.
Yeah, and I'll add to that. I completely agree with you, Tracy. I think what we've found is that you have to have a way to drive engagement with that experience, right? So you think of some of the kind of purebred kind of financial literacy programs or applications or whatever they might be. Kids aren't going to flock to that, right? They want to go play their Minecraft or Roblox or whatever it may be. So it needs to be something that's engaging or that incentivizes them to actually participate. And so one of the kind of key capabilities within the Incent platform is pay for chores. And this was actually, well, there are two catalysts to the creation of Incent, which I think is what's driving the activity. One is to pay for chores. So if you think about if you have a kid, back in the day when we were doing our chores, we got cash. Now a lot of stores don't even accept cash, so you've got to make it digital, right? So in order to get digital, you have to have a debit card, number one, and number two, they have to have money in the account. So if you create the ability for, say, for a chore, the kid takes a picture of the completed item and it goes back through the app, and the parent can approve or not approve and say, nope, it's not that good enough. You need to go fix the pillows or whatever it might be. There's an incentive for the kid to engage. So I think that's number one, is that, in order for them to earn their money, call it 14, 15 years old, they're generally getting chores or parents are giving them money, right? So that's one point of engagement, right? And then the second one is really around how do you build the financial education program that is contextual to what they're doing. As Tracy said, her son has no idea. I mean, most teenagers, my 26-year-old son, right? What's a checking account? I don't think he's ever written a check in his life, and he's 26 years old. So checking accounts are kind of obsolete. They're spend accounts. But in either case, you got to build that contextual education as they interact with the solution, because again, they're not going to go look for it, right? We need to present it to them in the context of what they're trying to accomplish, or give additional capabilities or features similar to some of the games where you reach a different level and you get new, weaponry or whatever it may be for Mortal Kombat, whatever it may be. In either case, you have to give them an incentive and motivation to go in. And generally at that age, it's money, right? So, creating
at any age, it's money.
Yeah, that's true. Good point. Yeah. So I think that's the kind of key there is one, just, how do you get them engaged? And how do you, while they're engaged, contextually give them the information, insight they might need as they are kind of traversing through their journey and through their life cycle.
You'll probably remember 15 years ago, maybe longer, banks and credit unions began to build in PFMs, personal financial management tools. Mm-hmm. I became fascinated with them. It dawned on me they were all failing, and they were failing because users found them really tedious and boring. Mm-hmm. It's today's tools do a lot of self-populating of forms. You don't have to input data that's already there. Yeah. How has the youth banking tools, how have they changed?
Well, I think, again, as Tracy mentioned earlier, the youth banking accounts were youth banking accounts, but there was no digital experience to engage them in that with that account, right? So you think of, like, as an example, if I'm a 35-year-old dad and I've got my bike, I've got a 28-inch wheels on my bike, right? But then I try and train my kid on how to ride this bike. Well, obviously you can't even touch the pedals, right? So you need to give him a smaller bike, right? Something that he can manage. So I think the key there is really around how do you create the things that you need to, again, to be effective with kids in that experience that becomes more engaging. So if you look back kind of 10 or 20 years, there was nothing available because most institutions were focused on delivering digital services for the adults, right? That 25 to call it 45, where, folks are getting cars, houses, boats, whatever it may be, right? And now that is saturated, now what's the next thing to kind of differentiate, and what do you need to do? It's you need to get the kids and the youth involved, but it has to be done in an engaging way. And so that's where we see the kind of biggest benefit, is creating a contextual youth experience that is engaging specifically for the youth. So it's personalized for the youth, right? So for example, savings buckets, and how do you name these accounts? It's not a checking account, it's a spending account or a budget account, or whatever vernacular you might want to use, but it has to be contextual and in order for it to work for the youth. And I think that's the biggest difference. And the fact that cash is now continuing to decrease in stores and things on that lines, and so the kids have to have a debit card to spend, and therefore a lot of times the parents are just giving them their own debit card, and then the kid goes onto Roblox and spends $200 on upgrades within Roblox. That's a real experience that one of our team members had. She gave her kid the debit card to go get something at the store, and then he ends up buying $200 worth of stuff in Roblox, right? And so now, because you have the ability to create a kid account and a digital experience wrapped around it, so you're enabling yourself to kind of monitor and control what that kid can spend, right? So there's a parent benefit and there's a kid benefit, and I think that's the biggest change that you kind of over the last, call it 10 to 15 years with youth banking. Tracy, any thoughts on your end?
Yeah, I even think about it. I have a friend, and her son, he rides motocross. He homeschools and he's on the motocross circuit. And she came to me one day and she goes, "How do I get him money?" And I says, "What do you mean by how do you get him money?" She said, "He's not old enough for a checking account, so we can't get him a debit card, because a lot of places at that time weren't allowing children to even have debit cards." She said, "I'm not going to send him cash, he'll lose it." So I look back now and I'm like, this would have been the perfect product for her son, because she's not always with him when he's headed out to races and stuff with his trainer, but she has to provide a way for him to get meals and to have the ability to be able to pay for gas for his bike and those types of things. So for this product would have been perfect for those times where parents need to be able to give their children access to money, but not send them out with cash. I can tell you, my son still gets cash from his grandpa and a birthday card and his Christmas card, and I find it laying on the floor in his bedroom. It seems like cash is just a piece of paper. He sees me use my debit card or my credit card to make payments at stores, and that's how he is growing up to learn how to do things. So I think for myself, we're shifting our youth into this without even knowing. We're training the behaviors that they see. And I think if you're not in those spaces and learning how to maneuver in those spaces with the youth as a financial institution, I think it's going to get more and more difficult, because the parents are going to start demanding these products. And if you can't provide them, there's too many out on the market space that are doing them as standalone. For me as a parent and as a consumer, I don't want to go to 3 different apps to be able to do something with my child. If I bank with Pioneer, I want to do everything with Pioneer. So I want to be able to see everything in that one space. And that is one of the reasons why we really engage with Marcel on the Incent, because it is going to be and feel like a Pioneer product. Not saying, yep, we're hearing you. We have a great third-party partner that we want to send you to. And I think that was one of the big things for myself, is I want to make sure that Pioneer is, again, responsible for providing the tools, making sure those tools are moving in the direction that our members want as well. So for me, I look back at that story with my friend and I'm like, I wish we could have provided her that, because her other option, or she said to me, "Can I not just make my son a joint on my checking account?" And I'm like, "Oh, do you know the liabilities that you're opening up?" And at that time, it seemed like it was the only option she had in order to protect her, to give her son, but also protect him from not losing cash while he was out and about. So I always look at those and think to myself, the tools are there and they're marvelous in the right ways, but we have to put them in the correct ways so that they're a benefit for not just the youth, but also for the parent, and that the parent sees value in that product.
Now, do the users of this card in your credit union, do they know Incent exists, or do they think this is all Pioneer?
So we're about ready to start the integration with Marcel, but it is white labeled. And Marcel, correct me if I'm wrong, but it is white labeled. It will reside in Pioneer's digital applications, and it will look and feel like Pioneer. So anyone that comes and signs up and starts utilizing these products for their youth will feel like they are with a Pioneer product, and they will contact Pioneer if they have issues.
That is correct.
Now, that certainly simplifies it. It's harder to sell people on this fintech they've never heard of. Whereas if they're doing their banking with Pioneer, trust them already.
Yeah, absolutely, and that's key, right? Is that trust? You already have this trusted relationship, and you've been at Pioneer for 10, 20, 30 years, whatever it may be. Why go out to a third party and give your customers to a third party to service them? Because it will be extremely difficult to get those kids back once they are using that third party's product. And as we've seen in the space over the last, call it 10, 15 years, as these fintechs start with one small little feature to disintermediate a capability, then they expand to ultimately become a full service institution. So I don't think that's any different than the youth bankings. Yes, they're focused on youth, but it's really a hook to bring in the parent, because the parent has to sign up an account. Now you've got interaction with the parent, and again, it's basically a Trojan horse when you think about some of the called B2C fintechs that are partnering with the credit unions and banks, because ultimately those accounts are leaving the institution as opposed to staying at the institution.
Well, for years, the big banks, the money center banks, have bombarded kids at colleges with credit card offers.
Mm-hmm.
And they were doing this because they were grooming the next generation of adult customers for themselves.
Mm-hmm.
I mean, this was pretty smart. And I'm sure now the fintechs are bombarding those same kids with additional credit card offers.
Absolutely. Well, I think that's the reason for getting engaged with these kids younger, because like you said, I'm 55, and the first day of school at the student union building, there were 5 or 6 different institutions with their little booths in the student union building offering up credit cards, right? So now that everyone's obviously doing that, how do you get the pre-young adult, right? The 6 to, call it 8, 17-year-old, right? And I know a lot of credit unions engage in financial education at the high schools, right? So that there's an effort and some kind of precedent to working with these kids before they even leave high school. The challenge is that it's generally just the education side without the application side, which is what we're working with Tracy and some of the other clients and investors to tie those two things together, so that the kids get in the financial education, but then he or she can go back home to mom and say, hey, Pioneer has a banking app for kids, and that might will help the family in terms of monitoring and kind of controlling what the spend is, et cetera. But it's about getting in there earlier, right? To your point, they get them at the college level. Now it's important to start looking at before they even get into college, right?
And I assume from what you've said that the parent can impose all kinds of limits and controls on the youth account. In other words, you don't want a $200 spend at some online venue. So you could put a limit of what? I mean, what kind of controls can you impose?
So you can impose daily limits. You can turn the card on or off. That's one of my favorite features, are the way position that we've talked about, kind of the on off. If there are some behavioral issues, you can just turn the card off. Right now, the kid can't spend anything.
Man, I used to misbehave all the time. Boy,
yeah.
My parents were. But no, that's cool. That's you didn't cut the lawn. You said you were going to cut the lawn. The card's off.
Exactly. And they're doing that in the same app that they're banking with. So with Pioneer, They'll just log into their Pioneer Banking app, shut it off, and it's done, right? And then there are other capabilities, that can be offered, including things like, per transaction, or it could be per store. So, for example, I heard a story where a mom was giving the kid allowance, and the kid was going to 7-Eleven and buying candy all the time, right? And so, the ability to shut 7-Eleven off as a spend location can be favorable for the parent as well, right?
Oh, that's cool. So you could also shut off like gaming sites, because a lot of gaming sites
exactly.
actually sell a bunch of stuff. Do you want super weaponry? Okay, that's extra money.
Yeah. Now that's all dependent on the processor and the card controls provider that is already kind of partnered up with the institution. But those are the only limitations that we have is what's limiting on the card controls that they already use.
Now, how many institutions are in your QSO?
So we have about 30 plus institutions who are clients, and Tracy and Pioneer, they're the first investor in the QSO. So they're the sponsor for the QSO. And then we have probably a dozen or so that are in deep due diligence for becoming members within the QSO. So we'll have a maximum of 8 in the QSO over the next, that we hope and expect to kind of bring on board over the next few months.
What's the size range of the clients, the customers?
Yep. So 60% of our customers are over $1 billion in assets. Our largest is Randolph Brooks out of
that's a biggie.
Yeah, that's a biggie. That's a biggie. Yep. So they're one of our they are the largest institution that's on the network. Like I said, about 60% are over $1 billion, and then remainders, I would say the smallest is about 300 million. So it fits any size. It's just how interested are you in engaging your kids? And we're finding that almost every conversation that credit unions are looking for a solution, and Incent was kind of under the radar for quite some time. In fact, it was developed by the CIO of Credit Union of America. So he was at Credit Union America when he kind of created the concept back in 2018. And so he's been building up his portfolio, and now like I said, we're up to about 30 institutions.
Now, what kind of technology does an institution need to work with you?
Technology that they already have. So the core processing system, obviously, we need to be able to access the core for balances, transactions, transfers, card controls, et cetera, and digital banking, right? So it's a fairly lightweight implementation. We integrate into the digital banking providers, and we are connected into just about all of the digital banking providers: Q2, Lumen, Alchemy, Banno, trying to Access Softtech, Jack Henry, Banno. So that's one side. That's where the experience is delivered, and then connectivity to the core processor. Those are the two kind of key technologies that we need to have access to. Other than that, we handle all of the other kind of wraparound services and the overall digital experience within our UX. And that's just plugged into the existing digital banking infrastructure.
If a credit union says, okay, it's a go, how long does it take to implement this, to actually get it up and running?
If we are already integrated with your core and your digital, you're looking at about 4 months. So 120 days. If we have to do new integration, obviously there's a little bit of time to do that new integration, but we have integration, like I said, to most of the digital bank providers and most of the core processors. Let's say 80% of our clients are on Scimitar, but we also have integration into XB2, correlation through a SDK capability. So we've got all the major DNA, of course. DNA is another one, but So
Randolph Brooks is on DNA. My memories are.
Yep, Randolph Brooks. Yep. Yeah. So for about 4 months, if we're integrated to either one of those, and again, may extend for 2 to 3 months to get a new integration to a new core provider, and a couple of months for a digital provider. So look at 4 to 6 months.
So what's as you developed this, what surprised you? Where did you say, geez, I didn't see this?
That's a good question. I think it was probably just the level of demand and interest in it. I knew there was a market, because I had conversations with probably 40 or 50 institutions before we even kind of got into this space. But I guess I didn't realize how much of a demand there would be. And I think, fortunately, there's a third party provider out there that is a kind of B2C provider. It's the kind of 800-pound gorilla in youth banking. They've been kind of laying the ground for us, right? So I think that has minimize the need to educate the credit unions on what needs to be delivered and how it's delivered. They get it, they understand it. So I think just the level of and kind of intensity on solving this problem was probably the biggest prize. How strong that was, right? I thought it would be okay. That's going to be we still have to educate them a little bit, but they know they need to do it, and we have the right business model to support them, and the integrations that will cover, call it 90% of the largest credit unions in the country. So
yeah, I get what you're saying. It's why did banks and at least some credit unions jump on Zelle? It's because PayPal scared them to death. PayPal really showed that people wanted this kind of person-to-person payment capability, and it was spreading, it was growing, and credit unions and banks were left outside in many cases. All I knew was they were processing payments through PayPal. And I think that's what really got them to move fast on that. And so I can see them looking out, seeing a fintech out there getting all kinds of business, and it's time to wake up and smell a coffee.
Couldn't agree more.
What's your fee structure?
The fee structure, we're making some adjustments. Historically had been based on asset size, but I think that's not as relevant to the number of youth accounts. So our new model will be a implementation fee, a per user fee, similar to the digital banking model, right? And with a minimum, and it'll be based on the number of youth accounts that sign up. So pretty straightforward. It's very similar to the traditional digital banking fee structure, and so we want to make sure that we're in alignment. It just makes it easier for the credit unions to understand the economics and what the potential upside is, and what their costs are, just based on the number of youth accounts that they have. And generally, what we're finding is that it's a 10-to-1 ratio in terms of parent to youth. So if a credit union has 100,000 members, generally they're going to have somewhere around 10,000, give or take a couple of points, right? So it's pretty straightforward, and it's been received very well. So we're excited about the future.
Do you have an age minimum for kids using this?
There is no age minimum. There's an age maximum, but no minimum. Right?
What's the maximum?
Maximum is, I would say, 19. You can still use the app up until about that point, and it's because we have a parental loan module that's built into the system, where if your kids want to borrow money from you, you can set up the loan, you can charge them interest, and then show them what that means. And if they do that late, let's say they're, call it 17 years and 350 days, and they want to get a $150 loan, we need to make sure that we extend that user experience out for the full year, if that's the term, right? So that's the reason for the cutoff at 19, is we want to make sure.
Hey, I can see many kids, 16, 17, possibly 18, wanting a car loan.
Yeah, absolutely. Yep. And the parents, if the parents want to give the kid a car loan and charge them 2% if they're really good, or 20% because you need to teach them what high interest loans mean, the parent can make that option. The parent chooses the interest rate. So I think one of the fan favorites is that parental lending module.
Parent sets up his or her own title company.
You got
it. Predatory lending at home.
Yeah, exactly.
No, I don't think that's a good use of the card, but you could do it. So
yeah. Well, the cool thing is you can actually refund the interest at the end of the term of the loan, or you can take it and go out to dinner, whatever it may be. So.
Is there any way to misuse this product? I mean, there are, but the parents can build in safeguards if they want to.
Well, I was just thinking about how could a kid game the system. I was just thinking about the chore module, because the chore module requires the kid to do the job and complete the job and take a picture of it. I think early in the earlier days, they could game it and use the same picture.
Oh, that's cool. I see people working for the city and they have to take a picture of when they finish the job. I know that because I asked the guy, why are you taking this picture? He said, I have to send it to my boss.
Yeah. So it's proof or evidence of completion. Yeah. So I was thinking about that one, but we've covered that one because you can't pull the picture from your gallery, right? So you have to take the picture. And I'm thinking of any other game that there's no ability to send money out. So we're keeping that kind of limited as well. We've kept it fairly limited explicitly to kind of minimize the gaming of gamification of kind of cheating the system. So there's not much there that you can do.
Now, Tracy, as you've gotten ready to roll this out to the members, what's been your process?
I think the process for us, we actually have a youth platform out there already that we've been doing now for just over a year and a half. And I think even though it's provided us the ability to give the parents something, it's not in our digital space. So we've always kind of kept our ears to the ground to look for it. And then talking with Marcel and the Typhone team, which is who does our digital banking, and really talking to them about what digital will look like. We kind of kept our ears down knowing that we wanted everything in one space, but we just knew we couldn't develop it ourselves, and it would have to come either through a QSO or it would have to come through the Typhone team itself. So I think for us, just preparing and making sure that we're having the right conversations as we onboard our youth that are already out there on other products, that we're onboarding the correct ways and really showing them the thought process and the tools that are being placed, but also reminding our members that we listen, we've been listening, and that we do take accountability. We do want to help them on their financial path, but also their use and anyone in the family, that we're not just here just to lend or for CD rates, but we actually want to have that full relationship with them that starts with their next generations as well, and really continue to build that trust through it. So I think for us, we're just excited to be able to offer this suite and have one more avenue for our members to really start making them see that Pioneer really is looking at every kind of movement in a person's life, and not just saying, yeah, well, we'll kind of push you off to the side and pick you up when we can put you into, the products and services that we built our digital for, which is that mid-A, starting at 18 and above, and hoping that they'll just transition back. And I think for us, we're just excited that we can really service our members from the time of birth all the way forward, if that is how we can, to make sure that it's there for them, I believe is probably the best piece for us.
Yeah, and we'll support the institutions with best practices, and we've noticed that the marketing and education going out to the parents is critical. We have some institutions that spend very little money and effort on marketing it, and we have others that build up community campaigns to actually create awareness in the community. As an example, Desert Financial in Phoenix.
Yeah.
They have been extremely successful. The number of enrollments is probably 3x of some of our other clients as a percentage. But I think the most interesting thing was that 75% of the accounts that were enrolled were net new accounts for the kids. So what kind of another way to think about that, if I've got 10,000 youth accounts right now, and I just brought on another 5,000 enrollees, but 75% of that is new accounts. There's 3,500 new accounts, right, for the kids. And we've had other institutions that see net new memberships because parents see that this is an option and they want to give the kid, the debit card and give them the kind of financial education component. So there's a complete kind of parental acquisition that's part of it, right? And so it's important for us to provide kind of the best practices from all of our credit unions and give the institutions that are now coming on board a playbook to help them and guide them through. Here are the best ways to maximize the value of this product for your members and for your members' children.
The cool thing about credit unions, unlike banks, is Desert Financial is not going to come to your house with a gun to your head saying, if you distribute to anybody else what we're doing, I'll shoot you right now.
Right.
It's whereas a bank might, or certainly they would feel like shooting you.
Yes.
Mm-hmm. And I live in Phoenix, and Desert Financial is omnipresent, to be honest. It's not the biggest credit union in Arizona, I don't think, but they do the best, most aggressive marketing. If I walked around town saying, I'll give you $10 if you can name one credit union in Arizona, I'd hand out a lot of $10 for Desert Financial and nobody else.
Yeah. Very, very, very strong marketers. Absolutely. And that's critical. You've got to educate the parents that this is available. You can't just put it up on your website and expect success. There needs to be some marketing and awareness generation to support the product.
Well, as an industry, credit unions are really poor to mediocre at marketing. And so often campaigns falter or even fail not because there's a problem with the product, but there's a problem with the marketing.
Right. Yep. And we've seen that. And we've seen that internally. And so, once we get our playbook together, we'll go back out and those who have minimal adoption, we want to make sure that they're successful in their endeavor to kind of support their youth.
Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey. Again, that's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.